Ready to soundtrack your summer? With Red Bull Summer All Day Play, you choose a playlist that fits your summer vibe the best. Are you a festival fanatic, a deep-end DJ, a road dog, or a trail mixer? Just add a song to your chosen playlist and put your summer on track. Red Bull Summer All Day Play. Red Bull gives you wings. Visit redbull.com/brightsummer ahead to learn more. See you this summer.
When you need to build up your team to handle the growing chaos at work, use Indeed Sponsored Jobs. It gives your job post the boost it needs to be seen and helps reach people with the right skills, certifications, and more. Spend less time searching and more time actually interviewing candidates who check all your boxes. Listeners of this show will get a $75 sponsored job credit at Indeed.com/podcast. That's Indeed.com/podcast. Terms and conditions apply. Need a hiring hero? This is a job for Indeed Sponsored Jobs.
Hello and welcome to Fintech Insider Insights, live from Money 2020 Europe in Amsterdam. I am Ross Gallagher from 11FS. Now, if you've walked around Money 2020 this week, it's hard to avoid one topic: stablecoins. They are everywhere. From cross-border payments and treasury operations to embedded finance and AI commerce, stablecoins have become one of the defining conversations shaping the future of financial services. But here's the question. Are stablecoins actually breaking into the mainstream financial system, or are they largely still trapped inside the fintech bubble? So in this week's episode of Fintech Insider, in partnership with Formance, we're asking, what will it actually take for stablecoins to break out of that fintech bubble? Now, to help us answer that, we really do have a fantastic panel today. First up, Ayelen Denovitzer, Head of Operations at Formance. Ayelen, great to have you. Welcome to the show. Maybe you can just tell us a little bit about yourself and what you're building over at Formance.
Of course. Yeah. Hi, everyone. Great to be here. Thanks for the invite. I'm Ayelen Denovitzer. I'm Head of Operations at Formance. And essentially what we do at Formance is that we build a programmable core ledger. I know those are heavy words to use in this context, but essentially we are asset agnostic. So we bring together on-chain assets and connect that to a fiat world.
Love it. You're definitely... That is the right expertise, I think, that we need to answer the question that we've just teed up. Also joining us, we have George Davis, founder and CEO of Lorum. George, also great to have you with us. Maybe, again, you can just tell us a little bit about yourself, a little bit about Lorum and the problems you're focused on solving.
Yeah, great. Thanks for having me. So with Lorum, what you can really think about us building is a new age Bank of New York, so bank for banks. We believe that really the market is structurally disincentivized to build good services for other banks in the correspondent banking side, and that really what we see in the market is a flood of smaller community banks making loans with deposits with kind of inherently transient money. And so the thesis for Lorum really was, can we build a 100% reserve-backed global custodian bank around the world? Previously, I also co-founded BVNK, so have some stablecoin experience and pain. But
Scars on your back. Love that. All right, and finally, we have Robin Anderson, the head of product at Tribe Payments. Robin, again, welcome to Fintech Insider. Maybe you can just, again, give us a little bit of background on yourself and maybe what you're seeing across the payments landscape on you.
Yeah, sure. So, as I say, Robin Anderson, head of product at Tribe Payments. So, Tribe Payments is an infrastructure provider and software provider for financial services companies, banks, acquirers, issuers, across the issuer processing and acquirer processing space. Primarily focused historically on the UK and Europe, but recently expanding out into Asia Pacific and the Middle East.
Love it. All right, well, that is our wonderful panel. I think from the expertise that we've just heard, I think we're very well placed to sort of dive into in a little bit more detail where we're at with stablecoins right now and maybe what the future holds. I'm going to start off with maybe the obvious question. Maybe I'll come to you first on this. Where do you think we are with stablecoins today, right? I mean, are we genuinely seeing it break into that mainstream financial system, or is it more hype cycle? Are we still just sort of talking to ourselves largely within a fintech bubble?
Yeah, that's a very good question. I'd first like to start to kind of put things in context, right? So there's specific use cases, such as accessing a hard currency or cross-border payments that were very obvious. These opportunities were captured mainly by either fintech or crypto-native companies, naturally, because they're more tech-savvy, they move faster, less risk-averse in a context that where, until not so long ago, we lack a lot of contextual set of rules, regulations, what we could do and couldn't do, right? So until this point, or not so long ago, it naturally, only these type of players capture these opportunities. Now, on the back of a lot of regulation coming in, Genius in the US, MICA with a similar objective in Europe, created a more fertile territory for the mainstream companies in the financial services space to start capturing these opportunities. So we are seeing a switch in the last couple of years, but it is accelerating recently, where more traditional players are starting to include some sort of either offering or using stables and moving money on-chain as a technology. So stables become less of a tagline and more of the technology of choice. Mm-hmm. There's tons of examples about top of my head. Visa, I think a couple of weeks ago, they announced that the annualized rate for settlements using stables for this year is $8 billion. If we put that in perspective of the size of what's being moved on an annual rate, that's still small, but it is signal that there's a specific trend, right? So players are moving into the crypto space in that sense.
Robin, Ayelen mentioned about the regulation piece. I mean, how critical, how fundamental is that to, I suppose, legitimizing stablecoins and giving companies out there the confidence to actually experiment?
I think it's absolutely fundamental, and I think the industry has massively underestimated how difficult that is. I think when people talk about stables, it's very easy to think that the difficult part is actually moving the value, but actually, you know what? In some respects, that's kind of a solved problem. Actually, the really hard part around doing this at scale is all the other stuff around it that FIs need to pay attention to. KYC, sanctions, liquidity, exceptions handling, audit trails, customer support, all of these kind of things that the FIs need to also do as part of their commitments, both from a regulatory and compliance perspective. So sending a stable coin from wallet A to wallet B, that can be really seamless. It can be really elegant. It sounds very, very compelling, but actually doing some of those other things at scale, that's the hard part.
I mean, it's, I mentioned the term hype cycle at the top, but, I think you have that kind of typical trend where, you've got these new emerging technologies, instantly all of the hype, all of the narrative, all of the noises, this is going to change everything. And then, Robin, I think to your point, the reality of the operational side of it and everything that needs to happen to actually fully embed it. And I think, we obviously haven't, we're sort of fairly far down the track. We obviously haven't seen it completely reshape the financial system. George, from your perspective, building that infrastructure underneath the money movement that Robin was just talking about, what's actually stopped stablecoins maybe going that a little bit further, really breaking into the mainstream?
I think generally, globally, we're not clear enough on where the value of a stablecoin truly is. I think in highly dollar illiquid markets, stablecoins can, for now, make a lot of sense because you can't buy local currency or you can't buy dollars out of that market and they're a dollar reflective asset. And that can be very interesting, but it's also very short term. Like when you look at why those markets have these structural issues with buying dollars, it is not because there's something wrong with the US banking system or all the dollar ecosystem. It's because there's something wrong with those governments hoarding dollars. And at scale, I think what you're going to see in those markets is stablecoins will become as illiquid. And so I think when you go to a major bank or you're selling treasury services into a bank and you start to talk about stablecoins outside of the hype, there's not really a need for a stablecoin across G20 currencies. Like we believe very strongly that SWIFT is not really broken. It's that the participants are. It's the participants that don't manage settlement adequately, and the number of hops in that chain is really the issue. And stablecoins don't really change that. They change maybe the messaging in between, and you're swapping a AAA credit rated correspondent with a crypto exchange in a local market. And I think what you ultimately see if you're doing, say, euro to Singapore dollar is that you end up going euro to dollar, dollar to USDC, USDC to dollar, and they'll often, the exchange in Singapore will wait for that dollars to settle in from the US, and then they'll buy Singapore dollars there. And so, yeah, I think you have to then ask yourself, like, who in reality wants to use that as their clearing mechanism? And I think it's mostly payments that shouldn't be processed by a correspondent, or in markets where correspondent banking doesn't stretch. And so I think there's a huge amount of value in tokenized bank deposits and reflecting tokenized balances around the world and tokenized assets such as money market funds in time. But I think actually stablecoins as a form of remittance is either for high-risk markets, dollar illiquid markets, or if you believe there's a future where you and I interact solely with stablecoins in our wallets and we never interact with the fiat ecosystem. And then it can make total sense. But how close to that are we? And I would argue, how much do we truly need that? And I think that has stopped stablecoins being completely embedded everywhere. And there's a lot of hype for leveraging them, but ultimately they're more expensive and they move away from a system that does work. It's just being leveraged wrong.
And then just picking up on the point that you made, because it's a really interesting one. Does that reflect a limitation in the technology, or does that reflect frictions and limitations in systems and everything that's sort of in place today that we've got?
I think ultimately the reason that you see difficulty now globally is that in the 90s you build on top of Citi's Treasury and Trade unit on TTS there, and that was great when money wasn't that transient. And so they've built a huge network of 100 branches or whatever it is, but each of those branches operates independently. And so you've got structural issues inside those large correspondent banks with kind of traversing the silos, traversing the manual execution. And we've ended up in a world where it costs them the same to execute, whether you have $100 million or $100 billion. So they naturally debank and de-risk. I think that's more of the problem than the rail itself. Like if you actually look at what SWIFT is doing, all they're doing is telling someone, rebalance your Nostra account. And there's no problem with that. And I think ultimately today, you still need to settle with central banks. You still need to settle over FedWire or faster payments or whoever. And actually, stablecoins are never going to bridge that specific gap. They're always going to sit on top of banking. I think then tokenized bank deposits can be more interesting because you capture that execution plus the branch network plus the deposit. But to imagine a future where we operate outside of your JP Morgans and your Citis or whoever, I think is slim. I think actually there's structural issues inside those banks that makes their services hard to spread. Yeah. But it's not actually an issue with the rail itself.
Ayelen, I think we jumped straight into the limitations, which I suppose is natural. But where are we seeing some real traction with stablecoins? What are some of the use cases where we're actually seeing them add real value and solve for difficult problems?
Yeah. So I'm from Argentina, right? We've been using stables for the past over 8 years. So it's not something new. And I think it goes back to what you were saying, George, on there's very specific use cases, such as regions or countries where you cannot access hard currency, where there's a real pain point. And there's definitely that's a problem. This kind of solves that. Maybe there's room to argue, does it solve it on the long term? Because if there's, for instance, in this specific case, if there's a restriction on access to US dollars, this is a bit of a workaround, right? Until it gets in the regulated environment, and then it's going to be capped as well. So that might be a bit of a short-term solution. Then again, it's been almost 10 years, and stables is still the solution for that problem. So yeah, I don't have a definite answer on where that is going to go. So far, it's been quite a success story, I got to say. And it opened the doors for global payroll. This economy is working for companies abroad. So I think maybe a couple of years ago, it was like, oh, stables are going to, or crypto is going to change and replace the entire fiat economy. And in 2026, I think all of us are pretty sure that's not how it's going to turn out. There's a fit. Sure, we can adopt this as just another technology that is better than whatever we're using now. But just saying like, oh, we will plug and play or just jump into the stables wagon because it's cool. I think we're kind of past that hype, which is good. I think it's a sign of maturity.
I think there's actually two fiat economy types where this works. There's one where there's no dollar liquidity, like Nigeria or somewhere. And I think that's a much shorter term use case. Like eventually that's going to run out of liquidity. When you get to scale, when you're moving hundreds of billions of dollars, that's going to be a problem. But I think where you have no faith in local currency, where you have no trust in local government, then there can be a very interesting use case there where actually you imagine that merchants inside the country that doesn't trust their currency are collecting in stablecoins and then banking with a bank outside of their home country. And they can be a really effective way to avoid local currency. I think the only place that you're going to see struggle with that ultimately is when that starts to really pull money out of the ecosystem of those countries. They are going to start to make it not a legal form of tender. But I think that's a much more solid use case where actually you don't want to hold the local currency at all. You never want to get in or out of that local currency. And you want local currency somewhere else, like a US dollar bank or a euro bank or somewhere. And I think that's where I think they can have a lot more traction than they do today. I think the liquidity use case is a poor one over time.
Interesting. I think the other thing, Ayelen, from the point that you made that stood out for me when you were saying about, look, I think we sort of have a handle on where we're at right now in terms of the role that stablecoin plays. But then I think equally, there's actually still quite a lot of maybe disagreement around the sort of the size of the stablecoin universe, even in the medium term. I think Citi and Standard Chartered have both sort of put out reports that sort of by the late 2020s into the early 2030s, they're expecting it around about the 2 trillion mark. Then I think JP Morgan came out with the report and said, look, if it gets to sort of 500 or 600 billion, it's actually done pretty well. And I think, you know, for me, I suppose the difference there is I feel like Standard Chartered, Citi, those guys are fully anticipating that it's going to break out of just solving for those sort of narrower use cases around cross-border payments, more into the sphere of sort of everyday banking. Whereas I think JP Morgan are being a lot less cautious and saying, actually, even today, a lot of what we're seeing in terms of the value around stablecoins that we're seeing is actually being driven purely from within just the crypto universe. And so that to me feels like a big thing. Robin, I want to bring you back in on the sort of the infrastructure point, because I know you've talked a lot about maybe stablecoins and AI running into similar problems in the transforming the existing infrastructure is actually much harder than people really realize.
Yeah, and look, I think there is there's always a natural bottleneck when it comes to payments infrastructure. That, you know, it doesn't matter if it's stable coins, doesn't matter what it is. You know, the front end, you know, the glossy demos, they're always going to be far ahead of the back end, and the back end is always going to be far ahead of the operating model or the operating layer. In the case of AI and stablecoins, if you even think about a use case where they're put together, right? Like, so AI can make decisions in milliseconds. Stablecoins can move near enough instantly. But the problem you've got is that most of these FIs, particularly the legacy ones, they're running off extremely old ledgers that have been built decades ago. I don't know, perhaps Formance can help with that. They're using batch processes. They're using manual controls. It doesn't matter what they put in their, in their glossy decks out to customers. Ultimately, this is how their processes run most of the time. So I think the point here is that whether it's AI or stablecoins, when it comes to payments, I think the tech is pretty much ready, but the banks aren't.
Yeah. George, how relevant? Because I think we do these insight shows, we go deep on a particular topic or a particular, whether it's stable coins or any other emerging technology, but none of these things are happening in a vacuum, right? How relevant is it that we're starting to see technologies like stable coins and AI coming to age at the same time?
I think in a world of kind of agentic money movement, stablecoins also can make a ton of sense because they're a way of immediately exchanging value. I think what we shouldn't underestimate is ultimately they have to leave that ecosystem eventually.
Yeah.
And I think that's where stablecoins can become a very interesting bridge between bank deposit tokens. So when you start looking at JPM releasing their own token, or Citi or whoever, I think it becomes interesting when your agentic commerce world can exchange value all day long through a stable coin. And then they need to get it back into the end bank account of the underlying merchant. And that's when you need your kind of interoperability between bank deposits and the stablecoin world. And I think stablecoins make total sense for that. It's way easier to have a AI agent interact with stablecoins where you've kind of got settlement finality instantly, which is something you really lack with a Swift payment or anything like that. And then it's about how do you bridge into that world, and banks are a natural liquidity source for that. So I think when I think about bank deposit tokens, I think about them more as a kind of like a market maker on the stablecoin side. They are like the liquidity source for getting back off-ramp out, because everyone talks of this vision of eventually you won't know stablecoins are there.
Yeah.
They're going to be this silent rail, the same way Swift is a silent rail. And I think for agentic commerce, that will be true. You won't really care how your agent exchanges value as long as your JPM account gets its deposit token at the end of the day. And I think that's very interesting.
I mean, surely that's how you know we have actually reached the final stage of the hype cycle, is we're not talking about it anymore, and it's just quietly...
When it becomes boring.
Right,
exactly.
And it's just quietly doing what it needs to do in the background. And we're sort of tipping into, Ayelen, we're tipping into sort of programmable money again. I mean, maybe where are we at with that in terms of, you know, where things are today, but then also, I guess, what are some of the challenges, some of the operational challenges about maybe realizing some of the more utopian visions around programmable money?
Yeah, so when talking about the challenges, just to put things in context, and because we were talking about adoption within a mainstream financial service company, orchestration becomes a real complexity. And the reason is pretty straightforward, right? No one runs money flows and payments on just one rail, right? So the money flow can touch bank, card networks, et cetera, and you're adding into that mix the stablecoin components. And the way money flows on chain is quite different, right? So just to mention a few things, but you were talking about finality, right? So finality operates completely, so you reach finality within seconds and it's always on, it's 24/7. That's very different from what we see with fiat money. Reversibility behaves completely different versus what you can do with fiat. So it's like you don't have exactly the same framework and way of moving money, right? So if you think of stablecoins just like you think of any other traditional fiat type of money flow, you're trying to put a square, circle, right?
It goes back to that point about AI. There's no point, using AI to write a business requirements document in half the time. You need to sort of go back to first principles and almost go, what does AI mean that we don't even really need business requirements document anymore? Or what's the future version of that, right?
Yeah.
So it's building from from first principles and ground up. All right, well, look, in this half of the show, we've just explored why stablecoins still haven't fully escaped the fintech bubble, and where they may finally be finding product market fit. We're going to move into the second half of the show, where we're going to look at what happens if stablecoins do become mainstream infrastructure and what that means for the future of financial services. It is all coming up after this quick break, so don't go anywhere.
So good, so good, so good.
Everything you want for summer is at Nordstrom Rack stores now, and up to 60% off. Stock up and save on the brands you love like Vince, Sam Edelman, Frame, and Free People. Join the Nordy Club to unlock exclusive discounts, shop new arrivals first, and more. Plus, buy online and pick up at your favorite Rack store for free. Great brands, great prices. That's why you Rack.
Study and play come together on a Windows 11 PC. And for a limited time, college students get the best of both worlds. Get the Unreal College Deal. Everything you need to study and play with select Windows 11 PCs. Eligible students get a year of Microsoft 365 Premium and a year of Xbox Game Pass Ultimate with a custom color Xbox wireless controller. Learn more at windows.com/student offer. While supplies last. Ends June 30th. Terms at aka.ms/collegepc.
All right, well, welcome back to Fintech Insider live from Money 2020 Europe. George, I'm going to come to you first on this just as almost like maybe a point of antagonism in terms of stablecoins and mainstream adoption and what we're talking about. Is it fair to sort of, I feel like I was getting a read from some of the stuff you were saying in the previous half of the show that like there's almost a challenge to like, should stablecoins become mainstream?
Yeah, and I think like with everything, it depends on the specific use case. And I think what I don't believe in is this world where everything is replaced by a stablecoin. I don't think that makes a ton of sense. I think as you start to see deposit tokens increase in usage, I think you'll start to see the normalization though. And really there will be less opinion on which rail is correct or not, because you take away a lot of the risk. Like what you see today with stablecoins is that you are shifting your risk from a correspondent to a crypto exchange in a local market. Well, if you imagine that actually you're using stablecoins for your kind of internet interaction, and then you are exchanging them for your bank deposit token, you don't need the exchange. Your bank becomes that exchange. It becomes a kind of central regulated exchange, and then they'll go and deal with burning and minting the tokens on the other side. They're likely also holding the deposits underneath all of the USDC or USDT that you actually are picking up. And I think then it opens doors for stablecoins to really just become a neutral asset that you may use or you may not. Whereas today, I think they're quite an opinionated asset to use because they present risk for large banks because money can move anywhere and it's difficult to be compliant with travel rule and everything like that. But also they present deposit kind of fleeting risk as well for the banks. And I think that's when we can neutralize that, that's when we can start to see this come through and just be generically useful all the time. But I still think G7 currencies, at least, it's not going to be your default rail of movement. So I think we strongly believe in kind of the future of tokenized deposits for that reason, but less so on the stablecoin sandwich of this kind of fiat, stablecoin fiat. I think they're just going to become your way to move out of the digital world and into the physical world.
Robin, do you think now with sort of more favorable regulation, like we mentioned in the previous half of the show, so Micah, Genius, do you think we're going to start to see at scale more meaningful innovation around the applications of stablecoins, looking at, actually, pushing the envelope a little bit in terms of where we can start to add additional value because the regulation is there, it's structured, it's defined, and that's going to give people confidence to sort of tinker a little bit in that space where maybe that didn't exist before?
Yeah, I think we will see that. I completely echo George's point, though, that I think it's going to be quite heavily use case dependent, and I don't think the world is going to be, all stables everywhere. But I do think that the evolution in the regulation is going to drive some of that additional innovation. Look, I mean, I'm a product guy. Like, the only thing I really care about is if there's a customer problem out there for a merchant or a consumer, how's it getting solved? If stablecoins is going to solve that problem, or it's a problem that's maybe been around for decades potentially, great. But actually, I'm less interested in the mechanic. I'm more interested in how that problem gets solved.
And that's absolutely the right way around. Like, start with a customer problem,
Exactly.
And then we'll figure out, all right, well, what's the best technology that we can apply to solving for that problem in the best way? All right, I have a multiple choice question. I'm going to come to each of you in turn. Ayelen, maybe we'll start with you. If we do start to see that wider, more mainstream adoption from a stablecoins perspective, who do you think is actually best positioned to capture sort of most of the value? We've got sort of traditional banks, fintech infrastructure providers, crypto native firms, all of the above. What do you think?
Shorter term, I'd say, and maybe I'm biased in this one, just because of the people we have on the table, but fintech infrastructure providers, I'd say, because we are sitting in kind of the massive middle that can normally capture more out of the value, but we can take things from point A to B. in the long term, I think everyone, right? And that's what we should be seeing. Banks are going to will be doing better just because they are using just a better technology. Crypto firms, again, they will become more regulated, more well established. Yeah. So in the long run, I'd say everyone, but shorter term, us.
I like that. I like that distinction between the shorter term and the longer term. And I also like the point of optimism that, like, actually there's potential there for everybody to benefit. Robin, what do you think?
Yeah, I'm going to slightly cheat and say all of the above, but in a similar way to Ayelen just mentioned, I think it's going to be different for different parties. You know, banks hold the customer relationship. Customer relationships with banks are super sticky. They have an enormous amount to gain by adopting and moving forward with stables, with specific use cases. You know, things like treasury and stuff like that. I think crypto native firms, with the evolution of the regulation, I think it, like we said earlier, it gives them the ability to experiment and differentiate that way. But I also agree with Ayelen that fintech infrastructure providers, it's the ability, you know, particularly selfishly, to take a stablecoin rail, integrate it into a wider acceptance or issuing ecosystem, and provide that in a way that's useful. I think the reality, though, is that the winner is going to be the one that can, you know, make it boring, compliant, and useful, right? Because you know something is mainstream when it starts to get a little bit boring. And that's, you know, as infrastructure providers, that's kind of what we're here to do.
I don't mind that you cheated and said all of the above, but I'm glad you expanded and it just kind of like ended there. That would have been tough. George, what do you think?
I think ultimately we'd be naive to think that the winner here doesn't end up the traditional bank. Like, I think I obviously agree in the early stage, like a fintech infrastructure makes a lot of sense, but who holds on to the underlying deposits that keep your stablecoin stable, right? It's fundamentally the banks. We're really just still playing a game of exchanging deposits around the world. And I think early stage stablecoins, they became a way of keeping money away from that. When we were looking at stables as a way to, say, continuously settle crypto trading online without leaving the ecosystem, there was an attempt to keep money away. And when you saw these programmatic stablecoins, algorithmic stablecoins that actually didn't hold any money, they just traded funds to remain stable, that was escaping banks. But ultimately, we're still just exchanging bank deposits. It's just a means for them to exchange faster. And so I think traditional banks, as always, will win because they will keep those deposits. So Circle will hold all of its deposits in the US and in Europe under MiCA with banks and in US Treasury bills, and they'll just become the biggest buyer of US Treasury bills over time, probably. But ultimately, the banks are still the ones who are going to be holding onto that money. And that's ultimately, I think, what matters the most. Like what rail we use to shift it between banks is slightly irrelevant in the long term, I think.
And firstly, George, I'm going to apologize because I feel like I'm kind of painting you as the pantomime villain a little bit, because I always come to you and I'm like, but why is this not going to happen? What are the limitations? But, you know, I suppose staying with that, you know, if we do start to see stablecoins become much more mainstream, what pressures does that put on the existing financial system, financial infrastructure? What starts to fall apart? What starts to break first?
And I think it's the same across all kind of high velocity payments. These large banks that have sat on these large deposit bases are not set up well to deal with a huge number of payments moving all the time between people that are not within their ecosystem, within their world. And so I think the pressure actually goes on still from a compliance perspective, because these banks are not ledgered even to deal with you know, JP Morgan moves $10 trillion a day or something, right? Something ridiculously huge. But if you then imagine stablecoins making that even faster and more common, what number does that multiply to? How many payments does that multiply to? I think that's when it starts to put a lot of pressure on, is actually those stablecoins or the deposit tokens can move to someone in a country they have no knowledge of and no control over. And historically, you could put large restrictions in place to stop your money moving into places where the bank wasn't comfortable. And I think stablecoins challenge that somewhat. So I think compliance is probably the most obvious place that's going to have that pressure. And today, I would say the solutions are relatively inadequate. You've seen recently, in the last couple of years, these crypto travel rule businesses start up to support that. But we need things to become much more mainstream. Really, like Swift as a consortium of banks, really, we need those banks to also information share across these stablecoin transactions as well, centrally for free, really. And I think that's a really necessary change for us to be able to move the sheer amount of money that is enabled by these faster, instantly settled payments.
And it's not, I mean, I think that captures the pressures that we're going to see from a sort of tech infrastructure perspective, but tech is just one lens, right? And Robin, you talked in the previous half of the show about some of the operational challenges. And obviously, I assume those only compound as we start to deliver some of this stuff more at scale. Is that something that, do you think as an industry, maybe we're not thinking about or underestimating?
I think the industry is thinking about it, but I don't think it's thinking about it hard enough. I know that's a bit of a cop-out answer, but look, I mean, when we think about what's going to break first when stablecoins become mainstream, it's not going to be the chain, right? It's going to be the operating model, because none of these banks, none of these larger FIs are going to go, okay, well, we're going to deal with stables separately, but we're going to keep our existing operating model for all of our other, deposit types and payment types and acceptance and all of this kind of stuff. They're going to try and merge those two things together. So at the moment that happens, you actually take away most of the value of the stables in the first place. So I do think that the industry is thinking about it, but I think it has no idea how to solve the problem.
Yeah, I agree. Ayelen, again, from an operational perspective, what do you think people are consistently underestimating about scaling programmable money?
Yeah, so again, I think it has to do with putting these two worlds that are so different and bring them together into something that makes sense, right? Because they operate in such a different way, it is challenging to maintain a single source of truth. And again, maybe I'm biased, right? But the problem that we are trying to solve at Formance is, okay, we do need a single source of truth where we, at any point in time and in a continuous way, we can track how much we have, where is it sitting, and who does it belong to. And I think that's non-trivial, right? Because sometimes we should use stables or we should move on chain, whatever it is. It's just a phrase. That's not a strategy. That's from saying that to actually implementing it and sorting all the operational challenges and compliance, because you need audit trails and you need to report to regulators.
Yeah,
so
exactly.
It's not that easy. So it way more complex than what it might seem.
I think this is why also you see so much of this token washing of financial services, money market funds. We spent a lot of time exploring with tokenization, and actually you end up seeing that there's not a lot of substance there, because actually they're charging you 15 extra bips to use stable coins, and then they're actually ultimately burning them and subscribing to the fund in dollars, and then they redeem from that fund in dollars, and they subscribe with USDC afterwards and charge you another 15 bips to do so, because they just can't merge the two worlds adequately. Like there's one world on one side and one on the other, and they're simply just kind of exchanging out of that asset and into the fiat world to go back to a normal traditional money market fund. And I think this is really where I think you just see everyone is kind of appending stable coins and tokenization and not really actually thinking through how the two worlds connect together adequately.
I'm really glad that I didn't tee you up for that one, because I was starting to feel bad that I was constantly coming to you for the what's the negative?
I think
what's the negative lens?
Everyone's always surprised because of the BVNK background.
Yeah.
I think it's just approaching this practically, where do these things really work? And we sit so low down the infrastructure stack at Lorum that we get a good sight of what makes sense and what doesn't.
Yeah, it's important to be realistic, right, in what some of these challenges are. George, I'm going to stick with you. I'm going to ask you an intentionally loaded question. Do stable coins eventually kill the traditional correspondent banking model?
I don't think so, no. Because even in a world where you use a stable coin, you still need a bank to give you fiat money on the other side. And that's still a correspondent bank. I think what people do is they really misassociate correspondent bank with SWIFT. And so, yes, stablecoins could pose some level of threat to SWIFT, as could any external network that allows banks to settle their Vostro accounts around the world. I think that stablecoins can, in some cases, pose a threat to that. You will always still need the bank. Even if that bank is just holding the stablecoin or collateralizing the stablecoin, you still need that bank. And so I don't believe that they threaten correspondent banking. I believe they threaten correspondent banks that won't innovate. I think they severely threaten regional correspondent banks who are just kind of monetizing their deposit infrastructure in a local market and allowing for correspondent payments to be made through that infrastructure. And they don't have the scale to operate with deposit tokens or stable coins, really, or the understanding when they're just so focused on building a lending business. That's where I think there is maybe risk for that. But I think you'll see the largest correspondents in the world become the largest movers of these assets if they do start replacing SWIFT. You'll see Citi will have the most stablecoin transactions like they have the most SWIFT transactions today.
Yeah, I completely agree. Robin, do you think we get to a place where just real-time global settlement on stablecoin rails is mainstream?
No, I don't. I think a lot of this comes down to there's this idea in nouveau payments that all friction is bad, when actually friction exists for a reason. Right, like when we talk about friction being bad, we're usually talking about it from the perspective of an account holder or a card holder or a merchant. But actually, some of that friction is designed for screening, AML, fraud controls, all of this kind of stuff. So even if stables become as ubiquitous as potentially some people would say, I still don't think you'll see that taking place.
Yeah, and you're right. I mean, look, positive friction is important, and preventing fraud and all of these really important things. Ayelen, I guess if we were to imagine a future where stablecoins do sort of break out of that fintech bubble as we described, what do you think the role is that they play in that financial system if we fast forward 5-10 years?
Yeah, I think it would become just another rail, right? So again, it wouldn't replace everything. It's just another rail.
Yeah.
So whenever it is the best solution, it is faster, cheaper, whatever it is, sure, we would be using that, but not by default, not blindly. And I think people wouldn't even know.
Yeah.
Just like people don't actually know how money is flowing today in the world. I think it's going to be just the same.
It gets routed to the stablecoin rail because there's a strong value case in the same way that it does
Exactly.
any other rail. Yeah, I couldn't agree more. It feels like we've absolutely flown through this, so thank you guys for what has been an excellent conversation. If you'll humor me, I would like just to wrap it up, sort of go around the room. I'm going to ask each of you in turn, what is the biggest misconception the industry still has about stablecoins today? George, I'll start with you.
I guess that they are a remittance rail, and that they are made for exchanging fiat around the world.
Love that. Robin, how about you?
That it's about the coin itself.
Yeah.
It's not. It's about the use cases and problems it solves, and it's about how it can integrate with the wider payments control architecture of banks and acquirers and other FIs.
Love that. Ayelen, how about you?
Yeah, I think hopefully we're moving away from that narrative, right? But this whole narrative about stables replacing the whole thing, or that it is the best technology to solve some of these problems. Just because you can doesn't mean you should.
Yeah.
And with some of these things, just don't.
I love that. Just because you can doesn't mean that you should. I think that sums up a lot of what we've talked about really, really well on the show. And I think the other thing, a clear takeaway for me in terms of what we discussed is the point around what's the customer problem? Like, yes, okay, there's this obsessive focus on the technology, but actually, how does the technology solve the customer problem? I think for me, that's a really important takeaway. Thank you guys so much. Before we finish, again, I'm going to go around the table, and you can just, if you don't mind, give me a sentence about what you think. Maybe if we have this conversation in 5 years' time, will stablecoins be mainstream? Maybe we can sum it up in a sentence. Ayelen, start with you.
Yes, but maybe by then it's so unglamorous and so uncool that we were not going to have this conversation.
Love it. Yeah. Robin, do you think we'll be here in 5 years talking about
I
stablecoins?
completely agree. No, we won't be talking about stablecoins. We'll be talking about something new, maybe the metaverse again, who knows. But no, it's just going to be another rail, right? And it's, as we say, if the use case demands it, that's where it will be implemented. So no, I don't think we'll be here in 5 years' time talking about stablecoins, because I think it will be mainstream, but boring.
Yeah.
I think boringly the same thing, that I think we just won't know. They'll be consumed into correspondent infrastructure, and we won't even know the difference between a deposit token and a stablecoin at that point. We'll just know that money's moved.
So rare that we finish a show where everybody's just like neatly agreed. It feels like we're sort of wrapping it up in a nice little bow, which I love. On that note, that does wrap up today's discussion. To end, and Robin, we'll start with you. Where can people find out a little bit more?
Well, there's about 7 or 8 Tribesters around, so I'm sure you'll run into one at some point. But if you want to find out more about Tribe Payments and what we do, tribepayments.com, or come and speak to me at Money 2020.
Super. Thank you, Robin. George, how about you?
Lorum.com. Feel free to reach straight out to me at george@lorum.com, but I'm also very active on LinkedIn.
Super. Ayelen?
Yeah, you can find us at formance.com. And if not, come talk to me. There's a bunch of us here at 2020.
Excellent. And as ever, as for me, you can find me on LinkedIn. Thank you very much for listening. If you like what you heard, follow our podcast, and don't forget to leave us a review. It really does help to make the show better, and it also helps others to find it. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider, or email podcast@11fs.com. Thank you very much, and goodbye.
There's a new way to Sweet Green. Meet Wraps. Handheld, hearty, and made for life on the move. With bold, chef-crafted flavors, fresh ingredients, and over 40 grams of protein, they're built to satisfy without slowing you down. Try Wraps today in the app or at order.sweetgreen.com. Available at all participating locations.
Security program on spreadsheets, new regulations piling up, and audit dread? It's time for Vanta. Vanta automates security and compliance, brings evidence into one place, and cuts audit prep by 82%. Less manual work, clearer visibility, faster deals, zero chaos. Call it compliance, or call it compliance. Get it? Join the 15,000 companies using Vanta to prove trust. Go to vanta.com/calm.
At Blinds.com, it's not just about window treatments. It's about you, your style, your space, your way. Whether you DIY or want the pros to handle it all, you'll have the confidence of knowing it's done right. From free expert design help to our 100% satisfaction guarantee, everything we do is made to fit your life and your windows. Shop up to 40% off with minimum purchase and a free professional measure right now at Blinds.com. Plus, pay at your own pace starting at 0% APR with Affirm. Terms apply.